Have you ever sat there, staring at a flickering red screen, watching your hard-earned capital evaporate in a matter of seconds, feeling that cold, sinking sensation in your stomach? It's a familiar story, isn't it? You're convinced this trade is the one. You've seen this setup 1,000 times. You go in heavy, maybe you even double your usual size, thinking that this is your ticket to a quick win, a way to pay off that credit card debt or finally take that dream vacation. But the market doesn't care about your feelings. It doesn't care about your rent, your dreams, or your pride. Within minutes, the trade moves against you, and suddenly, you're not a trader anymore, you're a gambler, praying for a reversal that never comes. That moment of realization, when the loss becomes too big to ignore, is where your trading career either ends or begins. Today, we're going to pull back the curtain on the most critical element of the markets, risk management. It isn't just about numbers, spreadsheets, or stop-loss orders. It's about the mental battle you fight against your own ego. Most traders lose not because they don't know how to read a chart, but because they don't know how to read themselves. You think you're in control, but your position size is pulling the strings of your nervous system. When you trade too large, you lose your ability to think rationally. Your brain shifts from a state of calm analysis to a state of survival, where fear and greed take the wheel. Scientifically speaking, this is known as the amygdala hijack. When you are over-leveraged, your brain perceives the potential financial loss as a literal threat to your physical safety. The prefrontal cortex, the part of the brain responsible for logical decision-making and complex problem-solving, essentially goes offline. And in that state, you make mistakes that you wouldn't make with a smaller position. You cut winners too early because you're terrified of losing the profit, and you hold losers way too long because you're terrified of realizing the loss. It's a vicious cycle that destroys your confidence and your account balance. Think of it like trying to perform surgery while someone is screaming in your ear. You simply cannot perform at your best. Let's talk about the reality of the game. Professional trading is not about hitting home runs, it's about surviving the strikeout. It's about keeping your losses small enough that they don't impact your ability to trade tomorrow. If you can't handle the loss of a trade, you shouldn't be in that trade at that size. It's that simple. But simple doesn't mean easy. We are wired to seek rewards and avoid pain, and the market exploits these evolutionary traits perfectly. When you increase your size, you increase the emotional weight of every tick. You're essentially betting your peace of mind against the volatility of the market. And the market is always going to be more volatile than your nerves. Consider the legendary traders, men like Paul Tudor Jones or Ed Seykota. They didn't build their fortunes by going all in on a single hunch. They built them by keeping their risk per trade so small that a string of losses wouldn't even dent their overall equity. They understood that survival is the prerequisite for success. Think about it like a high-stakes poker game where you're playing with money you can't afford to lose. You're going to fold early, you're going to play tight, and you're going to miss out on the best opportunities because you're too focused on the fear of ruin. The same applies to your day trading. When your position size is too large, you are effectively playing the game from a position of weakness. You need to shrink your size until you feel indifferent to the outcome of the trade. If you're checking your P&L every 5 seconds, your size is too big. If you're sweating when the chart moves against you, your size is too big. If you're praying to a deity you haven't spoken to in years, your size is definitely too big. You need to reach a state of professional detachment where the result of one trade is just a drop in the ocean. This is the foundation of a sustainable trader mindset. It requires brutal honesty with yourself. You have to admit that you aren't as smart as you think you are, and that the market can humble you in an instant. This brings us to the core issue, the lot size that is destroying your mind. Most beginners treat the market like a casino, looking for the big win that will change their life overnight. They don't realize that the big win is usually what leads to the big loss. When you size up, you're not just increasing your potential profit, you're increasing your exposure to your own psychological flaws. Every human has a breaking point, and when you trade too large, you reach that point much faster. You start making impulsive decisions, you start overtrading to make back what you lost, and you stop following your trading plan entirely. This is where the addiction kicks in. You start craving the rush of the big trade, and you ignore the discipline required to build long-term wealth. You have to understand that your position size is a reflection of your self-worth. If you don't value your capital, you will find ways to lose it. If you don't respect the risk, the market will force you to respect it by taking everything you have. I want you to imagine your trading account as a garden. If you plant too many seeds in a small plot, none of them will grow because they're all competing for the same resources. It's the same with your capital. If you overleverage, you're choking your account's potential to grow because you're constantly fighting for survival. You need to give your trades room to breathe. You need to accept that losing is part of the cost of doing business. When you treat risk management as a professional obligation rather than a suggestion, everything changes. You start to see the market differently. You aren't hunting for the perfect trade, you're hunting for an edge that you can exploit repeatedly over time. You stop looking for the home run and start looking for the consistent base hits. This is the difference between a gambler and a professional. The gambler wants the thrill, the professional wants the edge. The gambler wants the win, the professional wants the process. And the process begins with controlling your position size. It's about knowing exactly how much you're willing to lose before you even enter the trade. If you can't define your risk, you have no business being in the market. It's not about how much money you can make, it's about how much money you can keep. This is the golden rule of trading. If you want to survive, you have to be conservative. You have to be patient. You have to be disciplined. Most people fail because they want the reward without the work. They want the freedom without the responsibility. But the market is the ultimate mirror. It reflects your discipline, your patience, and your emotional stability back to you. If you're chaotic inside, your trading will be chaotic. If you're disciplined inside, your trading will be disciplined. It starts with your lot size. It starts with the conscious decision to trade smaller, to trade smarter, and to trade with a plan. Don't let your ego dictate your size. Don't let the fear of missing out force you into a position that makes you uncomfortable. Consider the 1% rule. Many successful traders limit their risk per trade to no more than 1% or even 0.5% of their total account value. This isn't just a random number, it's a mathematical firewall. If you lose 1% on a trade, you only need a small, manageable gain to recover. If you lose 20% on a single trade, you need a 25% gain just to get back to break even. As the percentage of loss increases, the mathematical difficulty of recovering that capital grows exponentially. By keeping your size small, you keep the math on your side. You allow yourself the luxury of being wrong because you will be wrong, often. Even the best traders in the world only have a win rate of 50% to 60%. The difference is that when they are wrong, they lose a little, and when they are right, they win a lot. This asymmetric return is only possible if you aren't forced to close a position prematurely due to fear. Stay within your limits, trust your process, and let the math work in your favor. Remember, the market will always be there tomorrow. There is no such thing as the last opportunity. There is only the next trade, and the next, and the next. Your goal is to still be in the game when the real move happens. Your goal is to be the person who stayed disciplined when everyone else was losing their minds. It's a lonely path, but it's the only path to true freedom in the markets. Take a step back. Re-evaluate your risk. Look at your trade journal. If you see a consistent pattern of revenge trading or tilt, you aren't looking at a lack of strategy, you are looking at a position size that is fundamentally misaligned with your psychological tolerance. Adjust it. Lower it. Test it. Observe how your heartbeat slows down, how your breathing steadies, and how your ability to spot market patterns actually improves when you aren't worried about the rent money. Start trading like you intend to be here for the next 20 years, not the next 20 minutes. Master your psychology or the market will master you. You are the architect of your own success, and the foundation of that architecture is your risk management. Stop looking for the shortcut, stop trying to turn $100 into $1 million in a week, and start building the boring, repetitive, and incredibly profitable habits of a professional. The market is not a place for the impulsive or the reckless, it is a place for the calculated, the calm, and the consistent. Choose today to be the latter. Shrink your size, widen your perspective, and watch as your trading career transforms from a cycle of destruction into a sustainable engine of growth. You have the power to change your trajectory, but it starts with the very next trade you place. Make it count by making it small, controlled, and intentional. The path to long-term wealth isn't paved with big wins, it's paved with the quiet, disciplined execution of a well-managed plan. Be the professional. Be the survivor. Be the one who stayed when everyone else left. Your future self is waiting for you to make the right choice today.